is Saturday, July 11th, 2026, and this is The High Road, Logistics and Leadership. I'm Elena Rossi, and I'm here to keep this operation from sliding into a liability nightmare.
I'm Jules Sterling.
I'm Buck Reynolds.
And I'm Dan Miller. We have a great show for you today.
Yesterday was a bit of a whirlwind. We spent a lot of time on the EPA's pivot on NOx and that broker liability ruling that basically stripped the shield from the middleman. Today, we're looking at a really packed episode. Everything from nuclear-powered warehouses to a total resurgence in M&A.
I mean, we're starting with something actually pretty inspiring. The way private networks are stepping in during the Venezuela earthquake crisis.
Yeah, the Amazon and DHL thing. I mean, it's one thing to ship a package of socks, but this is a whole different beast.
Yeah, and according to FreightWaves, Amazon and DHL have basically bypassed the usual aid bottlenecks. They've deployed these humanitarian air bridges to get over 100 tons of supplies into northern Venezuela in just 72 hours.
Look, the infrastructure is the real story here. The Simón Bolívar Airport in Caracas is down to one functional runway. One. That's a logistical choke point if I've ever seen one.
Exactly. And Amazon is running 7 weekly relief flights with the UN and Airlink. They're not just writing a check, they're actually using their own planes to move the needle.
It's an operational integration model. Actually, it's a fascinating shift from traditional philanthropy to using proprietary networks as the primary disaster response infrastructure.
I don't know. It's a bit scary how much the world relies on a few companies to actually get the food and medicine in. I mean, if Amazon's servers go down, does the aid stop?
Well, okay, maybe. But in the short term, they're doing what governments can't do fast enough. They're treating it like a high-priority delivery window.
It's a power play, but a good one. They're proving the network is the asset.
Just as long as the liability for those flights is clearly defined, because flying into a disaster zone is a risk management nightmare.
Speaking of nightmares, let's look at the aerospace side of things. President Trump just signed a Section 232 proclamation on commercial aircraft and engines.
I thought we were getting hit with 25% tariffs on everything coming from Europe and Canada.
Not yet. Look, the administration just opened a 180-day negotiation window. They're using the tariffs as a stick to force trading partners to adjust imports.
So it's basically a diplomatic ceasefire for 6 months.
Exactly. But the Commerce Department is claiming that over-reliance on foreign parts has caused a harmful cycle of workforce decline. They want the jobs back in the States.
It's a protectionist move. But from a risk perspective, reducing the dependency on a single foreign source is actually a sound strategy.
I mean, look at Boeing. They just cut the ribbon on a new billion-dollar line in Everett, Washington. They're trying to push 737 MAX output from 47 to 52 planes a month.
Right. They're betting the farm on the North Line to make a comeback. If those tariffs actually hit after the window closes, that billion-dollar investment might be the only thing keeping them afloat.
It feels like a high-stakes game of chicken with the global supply chain.
Oh, absolutely. Because nothing says stability like a 6-month countdown to potential tariffs. Which brings us to a different kind of stability, or lack thereof. We are officially in a zero-tolerance regulatory environment. I mean, the FMCSA is not playing around this morning.
What's the latest? More electronic logbook audits?
Worse. We're seeing a 400% increase in driver fitness-related out-of-service orders compared to 2024. And the biggest truck stopper right now? English language proficiency.
Wait, really? I mean, that's been on the books for years.
Actually, you see, the April 1st CVSA update turned it into a weapon. Inspectors are now doing a 2-step test, a verbal interview and sign recognition. No translation apps, no passengers helping, nothing.
Now hold on.
They're sidelining 2,000 drivers a month for this. If a driver can't explain their cargo or read a highway sign in English, they're gone. Period.
Well, I don't know. That seems a bit extreme. I mean, if the guy's a pro behind the wheel and knows his route, why are we pulling him off the road over a language barrier?
Because complacency is the precursor to catastrophe, Buck. If you can't read an emergency detour sign or communicate with a first responder, you're a hazard.
Look, from a business perspective, this is a nightmare for capacity. If you've got 2,000 drivers a month getting OOS'd, that's a massive hit to the available fleet.
It's creating this tension between the need for labor and the strictness of the law. I've got clients who are panicking about their driver pools.
They should be panicking. The era of paperwork compliance is over. Now it's technology and real-time enforcement. If your drivers aren't compliant, the DOT will find them.
Hey, before we move on, a quick note from our sponsor. Strategic logistics requires world-class engineering. This show is powered by the stack developed by Eric Christensen at Neural Network Media. Support the architect behind the code. Visit our Patreon at patreon.com/Neural Network Media for a free trial and access to our daily briefing PDF.
All right, let's pivot to something that's actually moving. Walmart is doing something wild. They've signed a nuclear power agreement with Constellation Energy.
Nuclear? For a retail store?
No, not for the stores, for the logistics. They're getting 176 megawatts of wholesale supply from the Dresden Clean Energy Center in Illinois.
Look, the point is, their new perishable distribution center in Belvedere, those 2026-era warehouses are energy hogs. Robotics, massive refrigeration. They need a power source that doesn't flicker.
It's the first time a major retailer has used a nuclear PPA. Usually, that's just for AI data centers. Walmart is essentially becoming its own energy utility to protect its cold chain.
I think it's a smart move. I've seen too many loads of reefers go bad because of a grid failure. If you've got your own nuclear-backed juice, you're the king of the mountain.
It's a strategic realignment, I guess. They're not just buying trucks, they're building the power grid to support them.
Exactly. And look at the vehicle side. Volkswagen is consolidating to high-margin segments, and Ryzen is diving into specialized vocational niches. Everyone is specializing.
I'm still skeptical about the EV transition in general. But if you've got nuclear power and specialized rigs, maybe it actually works. I'll believe it when I smell a failing wheel bearing on a nuclear truck, though.
You and your wheel bearings, Buck.
Speaking of specialization, let's talk about the rails. The AA-owned American Railroads just dropped data showing a 12.9% explosion in weekly intermodal volume for the week ending July 4th.
Now that's what I like to see. 6 months of growth in a row. The freight rail index is nearly at an all-time high.
Right. But the real story is BNSF's $4 billion bet in Barstow, California. They're building the Barstow International Gateway. Big. 4,500 acres of next-gen rail facility.
$4 billion. That's a lot of capital to lock into one piece of dirt.
Look, the strategy is the key. They're shifting freight from 40-foot international containers from LA and Long Beach directly into 53-foot domestic containers for the East Coast.
So it's like a massive filter that cleans up the flow before it hits the long haul.
Precisely. It removes the congestion from the ports and puts the efficiency into the rail. It's a huge play for domestic intermodal growth.
I mean, if they can actually get the transload warehouses running smooth, it'll save a lot of drivers from sitting in a port queue for 10 hours.
I'll be interested to see the safety audits on a site that size. A 4,000-acre facility is just a larger area for things to go wrong. Which leads us into the financial weeds. We're seeing a regulatory bifurcation right now. In the US, we've got a proposed $12 billion deregulatory package for trucking. But over in Europe and the UK, they're tightening the screws on Scope 3 emissions.
Scope 3. That's the downstream stuff, right? Like what happens after the product leaves the factory?
Exactly. A Paris court just ordered energy producers to integrate Scope 3 emissions into their legal vigilance plans, and the UK is making it mandatory for large firms starting in 2026.
The way I see it, this means your fuel providers and your shippers are now legally required to account for the carbon your trucks emit. It's not just a green report anymore. It's a legal liability.
Here we go again. More rules for the guys actually driving the trucks, while the suits in Paris decide how we breathe.
It's not just about breathing, Buck. It's about the balance sheet. If a shipper is legally liable for your emissions, they're going to start demanding green certificates or charging you a premium.
It turns emissions into a currency. If you're a low-emission carrier, you've got a competitive advantage in the European market.
And all this is happening while oil markets just spiked 6% because of the escalations in the Strait of Hormuz. We're seeing a volatility cocktail. Deregulation in the US, liability in Europe, and fuel spikes globally.
The truth is, you can't run a fleet on proposals and negotiation windows. You run it on diesel and sweat. And right now, the diesel is getting expensive again.
Which is exactly why the market is about to hit a breaking point.
And that brings us to the big one. The dam has finally broken. We are officially entering an M&A supercycle in transportation.
Look, the freight recession of the last 3 years is finally in the rear view. Tenny Group is reporting that buyer and seller interest has hit a 5-year peak. We're talking about a record-breaking seller's market by 2027.
I mean, the numbers are wild. Spot rates are running 60% above last year's levels. That gives sellers the clean financials they need to demand premium multiples.
Actually, the multiples are the interesting part. We're seeing 3 to 6 times EBITDA for standard truckload, but tech-enabled 3PLs are commanding up to 13.2 times.
I've seen a lot of tech-enabled companies that are just a guy with a fancy app. I'm skeptical about those 13x multiples.
Maybe, but the dry powder is real. Look at Apollo Global Management. They just launched a $7.3 billion bid for EasyJet. That's aviation, but it shows the appetite for transport assets is back.
It's a total land grab. After 3 lean years, the big players are finally ready to swallow the smaller ones who survived the dip.
It's a strategic re-engagement. They aren't just buying capacity anymore, they're buying capabilities. If you have a specialized niche or a hardened tech stack, you're a target.
I mean, I remember when you bought a company with a handshake and a look at the equipment list. Now it's all EBITDA and supercycles.
Fair enough, Buck. But the bottom line is that the market is shifting. The cautious wait-and-see approach is dead. If you're a mid-sized carrier with a clean book, you're probably getting a call from a private equity firm this afternoon.
Just make sure the due diligence is airtight. I've seen too many strategic mergers turn into a pile of undisclosed claims and lawsuits 3 months after the ink dries.
Well, okay. I think we can all agree that the industry is finally waking up. It's gonna be a chaotic ride into 2027.
I just hope the new owners remember how to actually move a load of freight without an algorithm telling them where to park.
That's all for today's High Road. We've tracked everything from nuclear-powered warehouses to the M&A supercycle that's about to reshape the industry.
Bye.
Later.
Peace out.
Keep the rubber side down and the liability low, folks.